Welcome to Option for All. Before we begin, let me ask you something. Have you ever felt that no matter how hard you try to pick the right stocks, the market still seems to move however it wants? You buy, you hold, you sell, you adjust, yet your results never feel consistent. If you've ever wondered why short-term stock trading feels like a constant uphill battle, the answer is simple. Stock trading isn't designed for short-term consistency. Stocks are fantastic for long-term investing. But if your goal is to generate regular, repeatable income, then you need a tool with more flexibility, more structure, and more ways to manage risk. And that tool is options. Options offer far more opportunities than stocks alone. But they also require deeper knowledge and a system to follow. Today's lesson gives you exactly that system, a 4-step framework that shows you how to build options, trades with intention, not guesswork. Let's get started. Step 1. Choose the right underlying stock. Every options trade begins with the same question: which stock should I trade? This step might seem simple, but it decides half of your success. When you choose an underlying, you want high liquidity, tight spreads, reliable pricing, strong daily volume, a ticker you understand. Liquid stocks give you faster fills, more predictable option prices, and easier exits. Think of well-known names: Apple, Microsoft, Tesla, Amazon, major sector ETFs, and especially broad market ETFs like SPY or QQQ. Trading options on thinly traded tickers may look attractive because the contracts seem cheaper, but the moment you want to exit, you can find yourself stuck with wide spreads and no buyers. So your foundation is simple. Trade options on liquid, well-known underlyings, especially when you're still learning. Once the right stock is chosen, we move to what separates beginners from informed traders. Step 2. Use implied volatility to choose the strategy. Options pricing is heavily influenced by something called implied volatility, or IV. IV reflects how much movement the market expects from a stock in the near future. High IV means the market anticipates big swings. Low IV means the market expects calmer price action. Why does this matter? Because IV directly affects how expensive or cheap an option is. And if we know when options are overpriced or underpriced, we know which strategy gives us an advantage. The rule is simple. When IV is high, options are expensive. Selling premium becomes more profitable. When IV is low, options are cheaper. Buying options becomes more efficient. Many new traders struggle because they buy options when IV is elevated, which means they overpay. And even if they're right about direction, the IV drop steals their profits. To avoid that, experienced traders also compare IV to another data point: historical volatility, or HV. HV shows how the stock has actually moved in the past. By comparing the two, we get a clear picture. If IV is higher than HV, options are inflated. Selling strategies have the edge. If IV is lower than HV, options are undervalued. Buying strategies have the edge. This simple comparison can completely shift your win rate because you're no longer guessing. You're aligning your strategy with market conditions. Once you know the IV environment and your strategy, the next step is fine-tuning your position. Step 3. Choose the right strike price. Strike selection shapes risk, reward, probability, time decay, cost, and how responsive your option is to movement in the underlying. To choose intelligently, you need to understand two components of every option: intrinsic value and time value, also called extrinsic value. Intrinsic value is the amount the option is already in the money. Time value is everything else: the uncertainty, the time left until expiration, and the demand for the option. Here's the key principle. Options closest to the current stock price, ATM options, have the highest time value. And what happens to time value? It melts. Every single day. This is why buying at the money options can feel punishing. They decay quickly, and you need the stock to move fast just to keep up. Many traders prefer in-the-money options when buying directionally because they contain more intrinsic value. They decay slower, they move more closely with the stock, they offer a higher probability of profit, and they're less sensitive to time decay. On the other hand, out-of-the-money options are cheaper. But cheaper doesn't mean better. OTM contracts have lower probability and often expire worthless, even when the stock moves in your favor. So your strike choice should match your expectations. ITM, higher probability, slower decay. ATM, fast movement needed, higher risk. OTM, speculative or for premium selling. Strike price isn't about picking the cheapest contract. It's about choosing the one that aligns with your trading thesis. With the strike chosen, you're ready for the final piece of the framework. Step 4. Choose an expiration that fits your time frame. Expiration determines how much time your idea has to play out and how quickly your option loses value. Short-term expirations, like 1 week or less, are extremely sensitive to time decay. They're great if you expect quick movement, but unforgiving if the stock hesitates. Medium-term expirations, around 20 to 45 days. Give your trade enough time to breathe, slow down the impact of daily time decay, and offer a balance between flexibility and cost. This is why many traders use this window for premium selling strategies. Long-term expirations, 60 days, 90 days, or even leaps, provide stability and slow decay but come at a higher cost. They're ideal when you want to express a strong directional thesis without the pressure of short-term timing. Here's the rule of thumb. Short-term, fast trades, quick catalysts, higher risk. Medium-term, balanced approach, great for consistency. Long-term, slow movement, strong conviction trades. Match your expiration to your idea, not the other way around. To build a consistent, structured options trade, follow these 4 steps. Choose a liquid underlying stock. Liquidity protects you from poor fills and wide spreads. Use IV and HV to select your strategy. IV high, sell premium. IV low, buy premium. Choose a strike price that matches your intention. ITM for stability. ATM for momentum. OTM for speculation or premium selling. Pick an expiration that aligns with your time frame. More time equals more safety, but also more cost. When you combine these 4 steps, you stop trading options randomly and start trading with structure. You understand why a trade makes sense, what your edge is, and how each decision affects your probability of success. This is the difference between trading emotionally and trading with a professional framework, and this is the foundation every Option 4 All member can build on. Join the Option 4 All community and follow us on Instagram, YouTube, X, and Facebook for more updates.